Hello guys, welcome. See you 2 hours. Hello, who's around? Who's there? Who's there? Hello? Please type and confirm that you're there so we can start the class. We're already late. Come on. Okay, I can see you now, IJ. Okay, let's kick off. I was expecting to see our new guest, but I didn't see him, so we'll have to start. Just a minute. Let me put this well. Fine. All good. 1 minute. Oh, the noise, that's the fan. But can you hear me still? Can you still hear me in spite of the fan? Exactly. So that I won't faint here. Alright. Sorry about the sound. Let me get my materials out. 1 minute, and we have this. I was visiting. Okay, you can hear me. I was looking for a way for me to impact knowledge quickly, at the same time cover up the syllables, and I found a way. For now, we are done with consolidation of financial position and also profit and loss statement, consolidation of P&L, but let me take you to the basic. So today is financial reporting. And I'll be talking a lot today we're going to talk about IASB, conceptual framework. Okay, Now I'm just going to talk about this for some seconds just so that I satisfy my conscience that we've talked about it. Now the IASB is International Accounting Standard Board. It actually provides the rules, conventions and definitions that underpin what forms the standards for the financial statements. How does it work? Now, you have to recognize you have a financial statement. The financials are your statement of financial position. Then you have also the statement of profit and loss and other comprehensive income. Maybe I should just put them in. We have the statement of changes in equity. These are things that I expect you to look up on so that we can concentrate on the crux of the matter. Now, these are supposed to give a fair representation of the activities, faithfully representing the activities which is being reported. Based on this, standards are being formed. IAS 1, IAS, different IASs which has come, and IFRS. You hear things like IAS, you hear things like IFRS, International Accounting Standard. International Financial Reporting Standard. So there are different IFRS and IAS. Now, what happens is that they sit down, the IAS body, they have different, I will drop something here so I can use for the explanation. Where is it? Let me clean this. Oh, this is not this part is not for me it's not the very interesting part. But you need to know it for the exam. They have these. IFRS Foundation. ISD. IFRS. IFRS Interpretation Committee. IFRS Advisory Council. Okay, I just want you to, after this I'm done with this part. It will come out as objectives or so. I don't see this coming out as one of the big questions, but it's needed. In the material I sent you, you can just look it up. This development and publication of IFRS by the IASB, these are the different organizations. This promotes and facilitates adoption of IFRS. The essence of this IFRS and the IAS, it's mainly there is a gap between, for like in the United States, it's rules based, and there is the plan is for a convergence to have some form of unified international reporting standard, so that if you have a company that manufactures chocolate in Australia, you have a country that manufactures chocolate in Nigeria, you could pick up their financial reports, and based on it has the same format for comparability, which is also one of the goals of the IASB. Interpretation helps in terms of supporting the application of the IFRS. They work with your local accounting, like there's an understanding between ACCA and ICANN to make sure that there's a convergence in different countries. You have local laws and regulations, so there has to be a convergence also. So it's not just a one-way traffic. In bringing up, like for example, currently for leasing, we have IFRS 16, which was just released in 2019. Now, it started off some years ago. I think, if I'm correct, like 2010 or so. And exposure drafts are being given. I need you to go and read that up. Those are on the steps. They will give exposure drafts, get comments from outside, and then they would publish it before it finally gets to the adoption also. So if you're okay with this, just let me know. I want to clean this up so that we can go to the standards. Oh, can you hear me now? Please tell me you can hear me now. Okay. So can I clean the board now? I want to clean the board. Please tell me yes, you can clean the board, so that we can move on to other things. Okay, explain. IJ, I will need you to read up on this, because I don't want us to spend much time on this. The IASB is the International Accounting Standard Board. What's their function? They develop and they publicize IFRSs. In your financial statements, we have assets, we have liabilities, we have equity, we have non-current assets, current assets, non-current liabilities, current liabilities. And different transactions and events move into these things. How are you going, the key thing you should remember is, how are you going to recognize them? How are you going to measure them? And how are you going to, in terms of the disposals, also recognize the disposals? We have different IFRS. We have IAS 16. Note, I said IFRS, there's IFRS and there's IAS. It's all started with IAS, now IFRS. So there is IAS 16, International Accounting Standards. Note, these are standards for different transactions and classification, recognition, measurement, and classification of these transactions. Example, IAS 16 is PPE, property, plant and equipment. Where does this fall under? It falls under the non-current assets. How are you going to recognize it? When I mean recognize it, how are you going to translate the big equipment that you are seeing? Let's say you have the value for a car. You bought the car for 10 million naira. How is it going to be reflected in your accounting statement? A standard has been developed to take care of that. What is that standard? IAS 16, property, plant and equipment. It would find out, one of the keys is to find out for IAS 16, is it being used for trading or is it in use? Example, you have land and housing, it still falls under IAS 16. If, for example, you are actually into the business of selling computers and you have a building which you are using as your head office. Note your head office. We are not going to IAS 16 now, just listen, it's common logic. In recording the cost of that building, the building is going to last for you, it has a useful life of, let's say, 50 years. That building is going to last for 50 years. And you bought the building for 100 million. Are you going to take 100 million and put into your financial statement in the non-current asset? The answer is no. I think we have somebody else in the house. You might have to say hello. Is that Ebenezer? Ebenezer is late for class. Ebenezer, I just type to say hello so I know that you're there. There's a place that you could actually say, you could put the chat. Ebenezer is here. Nice. Nice. I have 2 people in the class now. Okay. I was given a prep. You're welcome, Ebenezer. I was given a prep on the conceptual framework. I didn't want to spend much time on it because it's going to come out in your mainly objectives. I will need you to read up on it. It's about 2 or 3 pages, but just so that my conscience is being satisfied and I have ticked it off the syllabus, I just want to talk about it. This is a brief summary about the conceptual framework. Development of the IAS, should write it, notes, IAS and IFRS. International Accounting Standard, International Financial Reporting Standard. The key is standard. No, not the page. I'm just giving this now. I will tell you the page on. Even if I forgot, I'm supposed to send you something on. Supposed to send you revision kits. Then I'll send that to you after the class or so. I'm going to talk about this for just 5 minutes so that we can go off to the standards. So listen, please. IASB, International Accounting Standard Board, they are responsibility, development and publication of IFRS. Good. Now, we have other bodies that actually assist them in this. Look at it. The global aim is what? We are trying to get a unified financial reporting standard. A financial reporting framework whereby if you have a company in Australia that produces cars and you have a company here in Nigeria, which we are yet to see apart from Innocent, that produces cars, if they give their financials out, the financials we are talking about is statement of financial position, statement of profit and loss, and other comprehensive income, statement of changes in equity and the cash flow statement. If you look at it side by side, you would be able to compare them, comparability. If we say non-current asset, equity, non-current liabilities, and you go to another, somebody issues something else and you are saying cars, bonnet. It doesn't make sense. The essence of the framework, the conceptual framework, is it serves as a guide. No, it serves as a guide in order to enhance comparability. Just so you know, IFRS Interpretation Committee supports in terms of application of IFRS. We have local laws and regulation. Here in Nigeria, we have ICANN seems to be in charge of in terms of the laws, not like the laws, but we have tax laws and everything. But we have to help out in terms of reporting. These guys liaise with national laws and regulations in regards to finance and accounting. IFRS Foundation help in promoting and facilitating adoption of IFRS. Just so you know, IFRS Advisory Committee advises in terms of technical guide. That's why we have something like IFRS 16, which started out in 2010 and it was just adopted in 2019. And you are going to see it in your exam. IFRS 16 for leases. And you will see IFRS 15, which has to do with revenue. You will see that also in your exam. If you wrote financial reporting 2 years ago, sorry, the standards that covers revenue has been changed. Now it's now IFRS 15, and we're going to look at that. So I need you to, I'll send you some extra materials, but I need you to go down and look at just skim it through. It's not the big marks. It's something it's okay. I'm going to clean this up now. Don't worry, I'll send you this. But I need to make use of this class because I need to finish at least non-current assets. But we have advice on things. Today seems to be a conscious day for me. I'm like, I went through the syllabus. I'm like, okay, I think I was a bit too fast. I need to just fundamental qualitative characteristics. And we have relevance, faithful information, enhancing, qualitative characteristics. Comparability, verifiability, timeliness, okay. 2 minutes on this, so we have to move. Fundamental qualitative characteristics, still a line. I don't want you to be sucked into I have an exam, I have to finish the syllabus. Allow logic to just come inside. Think outside the box. Imagine that you have the whole lifetime to write this exam. I need you to just relax. If you are sucked in, it wouldn't help. Fundamental qualitative characteristics, there are two of them, relevance and faithful information. What does it say? Information has to be relevant. Faithful information. Like I was saying in earlier classes, I said the essence of whenever you hear of anything financials, we didn't come to this world to suffer. These things happened for a reason. Why would somebody just come up and say they have to provide financial statements? I will tell you why. You are a shareholder and you invested money in doing something. Remember that you don't necessarily have to work. You can put your money to work. You took your money and you gave to somebody who claims to have technical expertise in doing something, and you gave the money to him. Let's say it's Forex, and he went ahead, invested in the business. For me, I would want to be checking on the guy every day. The shareholders are like, okay, let us allow this guy do his work, and at the end of the year, we need some form of report. Yearly, we need some form of report. Remember, you would want to know the performance of the business. You would want to know in terms of cash what he's bringing in. You would also want to know, these details. Now, okay, you want to know these details. So, I'm not supposed to bring this here, but I will just bring it because you will soon write audit. Now, that is why the shareholders would employ the external auditor. The external auditor will vet the financial statements so that to find out whether the financial statements are faithfully representing the activities that happened. And they have their methods of doing it. But this is not an audit class. That is why these are the two keys. Is the information in there relevant? If the information is not relevant, then you are just giving me babladash. I'm asking you, what is the status of my money? And you're like, I went to Lekki. From Lekki, I went to Aja. That's not what I want to hear. What's the status of my money? I want to hear things like, we bought an equipment, and don't tell me, write it down. I bought big equipment that I will use in terms of the Forex, which was a very big computer, non-current asset. It goes into the non-current asset. Okay, why is it non-current asset? It lasts for more than a year. Now, I bought some things I will use like toners. I bought paper. Those things goes into where? Inventory. Where does inventory go? Current asset. Then, in terms of, I took a loan in order for me to finance a contract. That goes into where? Non-current liabilities. These are structured financial reporting formats which has been going over the years. The essence of the conceptual framework is to unify them. So key things you notice, this can give you 2 marks. 2 marks. Relevance, factual information. Fundamental. Enhancing qualitative characteristics, we have comparability. Like I've been saying, in order for you to be able to compare financial statement between 2 companies that are in the same industry, or between last year and this year, for which we are going to see because we are doing financial reporting. We are going to get into ratios, and the essence of ratios is also so you can all be able to compare the previous year with this year in terms of receivable days, in terms of inventory days, and your profitability ratio and all that. Well, we will definitely come down to that. Verifiability, you will have to have skepticism, so you know. Am I too fast? No, nobody see. Timeliness of information, because you can't be, for the year 20, if last year was 2018, and I expect that at least by first week in January I should get the financial statements, at least a draft, so I can know. Okay, Joma, sorry, I'm too fast. Okay. Timeliness, so that I should be able to get the financial statements at least first week in January or second week in January. But when I get the financial statements at the end of July, it defeats the purpose, because the essence is you have to be able to plan. Understandability, when you come out, most of the shareholders are not accountants. They are not vast in terms of accounting. So you have to put it in Readable formats, that's why there are disclosures also. We make it quite easy for them to understand. So based on this, I think we are done with this. It's 45 minutes and I want to hit at least clear some standards and solve at least 2 questions. Please forgive me. These are just going to give you 2 marks. And they are like 2 or 3 pages. It's a conscious thing I'm doing by going on this topic. I want to give you value for your money in terms of time. So I'm going to clean this. I'll send you the materials that I used in generating this. Don't worry. So based on that, I'm going to go to elements of the financial statements. If you have any question, please ask. You're free to pause me at any point in time. Please don't pause me. Okay, we have assets. Okay. Elements of your financial statements. After this, we're going to look at the format of the financial statement. I'm sure you're very well versed in it, but I don't want to assume. Because one of the keys of financial reporting is you have to have the format in your head. If they wake you up, you have to have the format. If you don't have the format, and we go ahead and we're talking about the standards, it's going to be an issue. Because first of all, you have to know what we're talking about, where is it going to? If I'm talking about contingent liability, IS 37, where is it going to? Contingent asset, where is it going to? Where do you think it's going to? You hear a liability, contingent liability. Of course, if you go to the liability side, contingent asset, of course, if you go to the asset side, we're still going to visit those standards. IS 40, where do you think it will go to? That's investments. assets. So you have to know the structure of the financial statements, both the standard statement of financial position and the statement of profit and loss. When you know them, after we look at this, when you know them, you practice them, write them out, tear the paper, write it out. When you're on the road, say it out. Statement of financial position, what is it? It starts out with non-current asset. After non-current asset, what is involved in the non-current asset? You have things like PPE, you have things like the intangibles, you have things like the goodwill under the non-current asset. What next do you have after that? You have the current asset. What goes under it? Inventory, receivables, bank, equity and liabilities. What goes under equity? We have the ordinary shares, we have the share premium, we have the retained earnings. Liabilities split into two. We have the non-current liability. What are non-current liabilities? Those are liabilities that are beyond 1 year. You have loans that are spans up to 5 years. They go in there. Liabilities, what do you have? You have your overdrafts. You have your payables. In your head. Then we'll go now to the statement of profit and loss. What do we have on the statement of profit and loss? First thing, remember, what's your profit and loss? Ijoma, you say thank God for this. That means you have been praying. The Lord spoke to my heart today. I was supposed to teach something else and I was just like, okay, no, we have to just hit this. Because I found out it's like you were struggling a bit in some things. Now, the statement of profit and loss. What do we have? Revenue first. After revenue, what? These are making me laugh. After revenue, what do we have? Cost of sales. What are all these big English they are coming with? Revenue, cost of sale. When you sell things, where do they go to? Revenue. Cost of sales, what does it go? The cost of you producing that thing, in there. Revenue less cost of sale, what does it give you? Gross profit. After gross profit, what do you have? You have the distribution cost. You have, for you, let's say if you are into production of, let's say TomTom, you have cars that carry those things around now. So distribution cost. You have the admin cost. Because you're an accountant, you're working somewhere, somebody has to pay your salary. Direct and indirect cost, that is F2. That falls under management accounting. I was supposed to take them today, and the students did not come. They don't know, they think ACCA is this. As I was saying before I got distracted. Indirect and direct cost. You fall under the indirect cost as the accountant. So it goes into admin. Now what else do we have in there? Depreciation. Depreciation goes in there as an expense. Then after that, what do we have? After those is now profit before tax. Down. Then we now have tax. After tax, we now have net profit. You have to have this in your head. As I'm saying it, not only just cram it, don't cram it, know it. Okay, cram it first. Know it, be able to explain it. And note, there are interrelationships between the statement of financial position and the statement of profit and loss. One key thing which you will notice in there is the closing inventory. No, that's what we are going to after this. I'm going to write it down, IG. I'm just explaining forward, so when I start talking about this, you would appreciate it. Now let's look at what I wrote on the board. Elements of financial statements. We have the assets. In giving your definition, these are key things you have to put into mind. Control. You can't have an asset if you don't have control. So you can say something like an asset is a resource which we control, which as a result of past events, we have inflow of benefits. Did I cram it? No. You have to find your thing yourself. Key events, liability. A liability is a present obligation which resulted as a result of past events, which an outflow of benefits. Leave all this English. The simple thing I'll tell you for understandability. Liability is somebody who is owing you money. No, liability. No, liability you are owing the person. And you know what? I'll write it down. For a liability you are owing the person. They say new. When in your books you have a liability, you are owing the person. So outflow of benefit means from your pocket you will pay. An asset, somebody is owing you. I love to be in that condition. So you're expecting an inflow of benefits, but also note, it's not necessarily an inflow of benefit. It can be a reduction also in liabilities. Equity, residual interest in asset less liabilities. Relax. When we solve questions, you will begin to appreciate it. Because one of the things I want you to do is, I want you to know it. I'm going to use the T account to debit and credit a lot for you. It might look hard now, but when you are writing the professional exams, you will thank me for it. Because once you get into the habit of knowing the debit and credit, life is made easy, especially when we come to deferred income. Income, now, this, you will see this in the statement of financial position, statement of financial position, equity, statement of financial position. You will see this in the P&L, statement of profit and loss, statement of profit and loss. And I will tell you for, okay, that's that. So we'll move now to the formats for the financial statements. We must get to a point where we solve questions. I really do not like English a lot, sorry. Before we get to the solving questions, okay, let me just write this. I'll just explain this. And I'll tell you why I'm explaining this. So that this sticks in your head. Those elements of financial statements we talked about, the figures that enter into them, one of the guiding rules are the standards, which I hope we will get into in the next 10 minutes. And the standards help us. I keep talking about IAS 16 because that will be one of the first that we'll go to. That's PPE, property, plant and equipment. The standard helps us in recognizing how to recognize the transaction in terms of value, recognize the transaction, how to measure them reliably, and the recognition, especially when it comes to IFRS 5, which is discontinued assets and assets held for sale. Come in there. I'm just saying these things, don't, so that it gets to the back of your head. So when we come to that standard, you'll be like, I've heard this somewhere. But just focus here right now. So this measurement, we have different forms of measurement. Historical costs are past costs. You bought one pomo. I used to buy pomo the other day, 100 naira. The other day I went to the market, it was 200 naira. And normally I like 2 pomo. I slice it like this, so it forms small periwinkle inside the soup. At the end of the day, I could only buy one. Confession. Current costs. Are you going to measure it at the current cost? Note, it is not for you to decide. It is for the standards to decide, not for you. Realizable value. Realizable value is, you want to buy, I've talked about Pomo, you're happy, AJ. You want to buy a TV. Let's say you want to sell a TV, and you're selling the TV for 50,000, and you have to go to the mainland to go and sell the TV. From here, you took Uber. At the end of the day, you spent 5,000. You didn't sell that TV for 50,000. The realizable value is 50,000 less 5,000, 45,000. That's what realizable value means. Present value. Just keep that in your head. Note that we'll solve questions and you'll know how. Present value. If I tell you I will give you 1,000 now and I'll give you 1,000 in a year's time, which one are you going to take? Ebenezer, I will definitely take now. The one where I see now it makes sense. Give me no, how to see. I don't want to hear story. There might be election, Buhari might lose and everything. I don't want to hear story. Now, if I have to give you that 1,000 naira in future, the value is not going to be the same. 1,000 naira now is not 1,000 naira in the future. That is what is called time value of money. When we get to present value, you will now understand better. But one thing you should note is, if you have 1,000 naira in future and you discount it down, it's going to be less. Why? If you give a bank money, 1 million naira, what do they give you? Interest. Some people do fixed deposit account. They give you interest. The reason they give you interest is, they tell you, like for fixed deposit, keep your money for 1 year, don't come and touch it, and we'll give you a higher interest. Meaning that if they give you a yearly interest of 10% and it's at 1,000, in 1 year time you're going to get 1,100 naira. If you discount 1,100 naira by 10%, it definitely might come back to 1,000 naira. We'll still get that into that, just so you know. I'm done with this. I'm heading somewhere. I'm heading somewhere. Let me write something and let's see. You are going to type your answers. I want you to, there are two answers to this. Look at this question. It says the ISB conceptual framework for financial reporting identifies characteristics which make financial information faithfully represent what it purports to represent. Which of the following are examples of characteristics? You have to type your answer. I'm waiting for you to type your answer. Ijoma, I'm waiting for you. Only you will be in the exam hall. I'm not going to be there. I only tell you, read the question again and see what it says. Faithfully represents. Okay, now. Simile. I like taking off the one that does not make sense. Faithfully represents what it purports to represent. Going concern, no. Completeness and faithfully represent, yes. Now these guys are quite very tricky. Anybody who sees Aqua will quickly think that yes, Aqua. I could put an Aqua of nonsense in my account. I remember in my days when I was on a project in Total. Jesus, I'm not supposed to say this. Not Total. I've said I was in a certain project. Disclaimer. And at the end of the month, we are supposed to take the work which was done but which was not invoiced, create accruals for them. And sometimes the engineer will be like, we've done this, we've done this, we've done this. I said, okay, just sign it. Hello, is anybody there? Please tell me you're there. Ijoma, are you there? Beniza, are you there? I need to know you're there before I continue. Please help me. Are you there? Are you there? Nobody's around. Nobody's around. Why? Thank you, Ebenezer. I was thinking nobody was there. I was saying 0. So as I was saying, they will tell us to do, we normally do accruals at the end of the month because most times the invoice, the on-site, let's say they have a scope of work. Thank you, Ebenezer. They have a scope of work from 1 to 10. We have budgeted, listen to what I'm saying, so you can understand this point. we have budgeted that we're going to work do from 1 to 5 in January. Now, the project engineer on site, they might have done only 1 to 2. But when I'm asking him, he says we have done 1 to 3. Because of he doesn't want it to affect his performance rating. Sometimes when I'm not able to go to site, initially when I didn't know that they did that, I would take an accrual of 1 to 3 and put it. Does it faithfully represent the activity? No. You could accrue the correct thing, you could accrue nonsense. So accruals, no. Completeness is when the guy tells me we have done 1 to 3, and I'm like, okay, I want to see. Completeness, skepticism, even if he's my friend and we have been working for over 3 years, I still want to maintain some neutrality in it. So, completeness and neutrality, that's it. Just to give you a flip twist of how the objectives go. But let's head on now. I'll clean this up. I think I just have you, Ebenezer Ijoma. I don't know what is wrong. Ijoma, if you're there, please let me know you're there. I still have to continue. Ijoma is not responding to me. Okay. Yeah, welcome back, Ijoma. Yes, the answer was neutrality and completeness, Ijoma. Neutrality and completeness. And just so that you are not left out of it, I said in terms of accruals, you can accrue rubbish or you can accrue the current things. Managers have been known in industries to, especially at the end of the year, December, to pack in a lot of accruals into their performance because of they want to achieve the budget which was allocated to them. When you have a budget, it is not mandatory that you must spend it all. But The downside of it is, if a budget of 10 million was approved for you in 2015, at the end of the day you ended up spending 2 million. Do you know what you're doing as a manager? You are actually costing the company money, because in terms of capital rationing, that's an F9. In terms of capital rationing, you can use the money to do something else. There's opportunity cost. Money not used is costing you. Money that you keep in your house is costing you money, because you could put that money in the bank and earn 10% on it. So money kept idle, as a manager, you fought, and you got $10 million worth of budget. At the end of the day, you only use 2 million. What they normally do is, at the end of the day, they pack in a lot of accruals. So that is one of the reasons why accruals do not faithfully represent the financial statements. One of the things that represent the financial statements are that you have to be neutral. That is, even if the person, the project engineer, is your friend over 5 years, you have to have a neutrality about it. Professional skepticism and professional judgment has to be brought. Professional skepticism and professional judgment has to be brought in, because that is one of the characteristics of an ACCA accountant. Now, in terms of completeness, it has to be complete. When I mean it has to be complete, it does not mean that there might not be one or two small errors, but there should not be material errors which can lead to material misstatements in the account or so. So the other one, going concern, I don't know what they were writing there when they say going concern. Going concern, I mean, the company is closing if it's going concern. It has nothing to do with the financials. So the answer is completeness and neutrality. Now, I'm having conscience crisis. That's why I'm doing all of this. These are the processes that is normally being taken by the IASB in developing a new standard. There's a public board meeting, agenda papers, agenda consultation. Just finding the money can get this in your head, because I think when I wrote my own, it came out. Discussion papers will be issued out to the public. An exposure draft will be issued out to the public. The discussion paper will be issued out to the public, Based on the discussion paper which will be issued out, feedbacks will come in based on that exposure draft, and then the vice exposure draft. New IFRS is issued, IFRS is adopted, then the post-implementation review. Look through the materials I sent you, you will see this. I will send you some materials. For you, Ebenezer, I will send it to you. You have to send me, after the class, send me your email address if you think we are good enough. So, straight up, I'm kidding. I'll still send it. I'm kidding. Okay. Presentation of financial statements. Like I told you, we have the statement of financial position, statement of profit and loss and other comprehensive income, statement of changes in equity, the statement of cash flow. We have the disclosures. Notes to the accounts. So for now, I'm going to do this. I need you to write this down somewhere, because after this we are going to a standard. I'll just do this. I'll just write for the statement of financial position alone, because the standard I want to talk about is the statement of financial position. I'll send you the materials after, so you can look at the format and make sure you practice them out, so we can save ourselves time and make use of the time remaining. Sets. Okay. Quite lengthy. Are you done? Okay, I can continue. I didn't want to clean something, but I left out one. Under here, there's supposed to be one. Current asset held for sale, but there's no problem. I need you guys to do something for me. If you want to pass, if you know you are serious about passing, know this. Not just this. I'll send you material, Ebenezer. I think you have it in that material, Ijoma, the one I sent to you. You have to know this. There's no shortcut to it. Know this. This is the statement of financial position. Then you know the statement of profit and loss. You also have to know statement of changes in equity. For cash flow, we will handle cash flow as a special topic on its own. But if you go ahead and know it before we handle it, fine. The same attention I gave to consolidation, statement of financial position, that's the same attention I want to give to cash flow. You have to know this. But note one thing, I'm going to talk about IAS 16 for now. So you have to know where IAS 16 falls. This is PPE, property, plant, and equipment. And we are going to be talking about how to recognize this, how to measure this according to the standard which was issued by IASB, International Accounting Standard Board, via IAS 16. So when I say IAS 16, you must not know. If you know the nomenclature IAS 16 is okay, but if you are confused about it, there's no problem, leave it. They will not penalize you in the exam. Just say property, plant, and equipment. But once you say something over and over, it gets into your head. So this is what we are going to talk about. So I'm going to clean all of this, but I'm just going to leave this so that we can have a pictorial view of what are we talking about. We are recognizing something. Where is it going to go into? I'm going to clean it up to here so I can do something else. Okay. I just did a snap. This is not the full statement of profit and loss and other comprehensive income, but so that I can talk about IAS 16 as a standard and relate to this. So good, let's go to non-current assets. Okay, non-current assets. Okay, non-current assets. There are 4 standards that fall under non-current assets. IAS 16, IAS 23, IAS 20, and IAS 40. We'll talk about IAS 16 today, and we'll finish this off in our next class. IAS 16 has to do with plant property and equipment, IAS 23 borrowing costs, government grants, investment property. And when you're talking about the standard, one of the things that comes to your mind is how do you recognize it? How do you recognize it? How do you measure it? And when such a thing is being sold, how do you de-recognize it? And the language of accounting is double entry. So in recognizing it, one entry, there's a debit somewhere, there's a credit somewhere. In de-recognizing it after it's been disposed, there's a credit somewhere and there's a debit somewhere. And how do we measure it? We talked about different kinds of measurement. We said historical cost, we said present value, we said current cost, fair value, net realizable value. So measurement and recognition. Please, can I clean here? I'm sure you have it in your notes. I'm seeking permission. Can I? Please? Yes, thank you. Even though I didn't hear anything. Thank you. Don't crucify me again. So we have measurement. IAS 16, PP. Measurement and recognition. Okay, thank you. Wow. I love you, you are too much. Too much. So recognition at cost, purchase price, assets to its location. Permit me to finish writing, then I'll explain. Okay. I have questions that I want to set after this, but that will be to benefit you, IJ, but to not benefit Ebenezer, because don't worry, I will detect it. I will detect it because I have not sent him the revision kits, and I want us to do this together. And even if we start now, we will not finish. So let me explain this. After explaining this, within this, we will continue tomorrow. Then I will send it at least tomorrow morning to you guys. I will tell you what we will solve so that you will be prepared for it. So you can be able to ask questions. Okay, let's go. IAS 16 PPE. There were 4 of them, which normally comes up under the non-current assets. Now we have the IAS 16 PPE, plant, property and equipment. We have borrowing costs, You borrow money, how are you going to recognize it? We had investment property and we had government grants. But for now, we'll look at recognition and measurement of property, plant and equipment. Straightforward, this is almost like English language. It is measured at cost. Remember we said there are different types. There's historical cost. Historical cost is measured at cost. Then, what things could you recognize in terms of measurements? Purchase price. You're buying a car. Purchase price. The price you have on your invoice. What other things can you recognize? Remember that you might go to Akure to go and buy a lorry and you're bringing it down to Lagos. You are allowed to put direct attributable cost of bringing that lorry from Akure down to Lagos. That will also form part of the cost. You understand? The value which you see for PPE. Remember when they say PPE when you see PPE in a company's account, it's not just the value of one computer. It's the value of different assets that qualifies as PPE. What qualifies as PPE? You see land and buildings qualifies as PPE. Property, plant, equipment. All those machines they have there, they qualify as PPE. Property, plant, equipment. Things that you spend money on, generally which you use in the company. I didn't say not things that you buy money on and you want to resell. No. Things like the head office of UBA, which is at Marina. That is, as far as they are the only ones using it, if they are the only ones using it, it falls under PPE. So they gather all those things, plants, and all the equipment they have, gather all of them, plus the attributable cost of bringing that asset to their premises, and they all form a cost which goes into PPE. And the wonderful thing about it is, if you have a rig, like for those that work in the oil and gas industry, a rig, the cost of mounting the rig, and the cost of dismantling it. Remember, if you mount a rig now, you might dismantle it maybe 5 years time, 20 years time, when the oil is finished. You now take that cost and you put it in PPE. How do you do it? If the useful life of the rig is going to be 20 years, you estimate that, okay, the dismantling cost is going to be $10,000, $1 million. You will now discount it. We will get to discounting, meaning that you will take that amount, $10 million, and bring it down to today's 10. That's discounting, and include it in the PPE. We will get to the part of disposal of it, but taking it one step at a time. And one other thing you will notice also is, if you have a house, if you have any questions, you could just let me know, because we're about to end the class. If you have a house and you bought the house let's say 10 years ago for $30 million in Lekki, phase 1, the price of the house now would be close to about 100 million naira. If you're carrying 30 million naira in your books, and the market value of that house now is 100 million naira, does it faithfully represent what is on ground? I'm sure you said no. So there is something they call revaluation. PPE is actually recognized and measured at cost, but you can choose to revalue it after a while. Like, you have a house that you bought 10 years ago for 30 million, and right now the price of the house is 100 million. You can revalue the amount to 100 million now. But one thing is, if you choose to revalue it to its fair value, they call it fair value. You choose to revalue it to its fair value. It's a new standard now, which we would also look at. If you choose to revalue it to its fair value, you have to consistently revalue it. Either you're revaluing it annually, you're revaluing it biannually. You can't just choose you're revaluing it now and you stop. You have to once you start, you have to revalue it annually. Every single thing that has to do with it. And we'll go to the treatment of revaluation on this. So I want you to take a look at PPE and its treatments, debit, credit, and we'll look at that, and we'll look at IAS 40 tomorrow. I'll send you some questions we saw. Generally, in terms of when you buy something, you definitely know you debit PPE and you credit the back. Generally. So, any questions while we end the class for now? End the class now. Do you have any questions? Who is still there? I can only see one person there. Okay. Thank you very much. Crabbe's tutors, we're here for you.